Now for something completely different.
Forget everything you've been told by others before.
Because I've never heard anybody wake up in the morning and go, Cheerios are delicious. So,
Get ready for the real deal.
You know what my wife's favorite cereal is? Still to this day. And I'll catch her in like the pantry. Lucky Charms.
The full story.
Well, they are magically delicious.
They are magic, but she'll like go in and she doesn't eat cereal with like milk.
Yeah.
She just sticks her hand in the box, gets full of the Lucky snack. Yes.
The whole enchilada.
That's her snack. And it's her own box. Nobody will touch it because she sticks her hand in there.
It's money, news, and information you can use to grow financially healthy, wealthy, and wise.
I will disagree with Chad. They said don't go on credit to buy Girl Scout Thin Mint cookies. Totally disagree. That is a need. That is not a want.
Now, welcome in The Real Deal, the real investment show with Lance Roberts. Presented by RIA Advisors.
And good morning and welcome to the show. Of course, it is Tuesday. That means it's Two Dads on Money, and Jon Penn joining me this morning. So we got a lot of stuff to get into, everything from bonds to interest rates to a whole variety of other stuff. So we've got a few topics to go through this morning with you. Economically, not a lot of news out today. We do have PCE this week, and then, of course, the Jackson Hole Summit. But again, tomorrow is the big day with NVIDIA's earnings. So the market's going to kind of just trade flat until we get to NVIDIA tomorrow. In tomorrow's daily market commentary that will come out at 7:30 in the morning, I'll have a kind of a complete preview on NVIDIA's earnings in that, so you can kind of get prepared for that earnings announcement. This is really the last big report for the market for earnings for this quarter earnings season. And we're going to go into a bit of a lull over the next month and a half until we get to do this all over again as earnings season starts up again in October for quarter three. So, you just always have something around the corner. Outside of that, of course, the big news yesterday was the Treasury's announcement that they're going to use the TGA, which is the Treasury General Account, to potentially, buy back bonds, et cetera, in the markets. And this isn't, again, there's been a lot of headlines about this, lots of, considerations, but the Treasury General Account is a Treasury liability, and they can use that cash, that's what it's there for a whole variety of purposes, and they use it from time to time. That cash account has been building up over the course of the last couple of years. It's been building up. So again, this is going to be another action by the Treasury that is going to be trying to use just to try to bring down some of this term premium that exists. And we went through a lot of this yesterday, talking about the basis trade, where 50 hedge funds basically own about 8.5% of the Treasury market, and that activity that they're doing on this basis trade is skewing, there is an impact on that term premium. And of course, the higher interest rates go, the more it has an economic impact. People don't finance cars. In fact, if you take a look at used car financing, new car financing, that's been dropping off a lot because of interest rates. Interest rates go up, it basically degrades demand within the economy. That slows down economic growth. So naturally, the Treasury wants to try to get that interest rate back to a level where it is supportive for economic activity and economic growth. So that's all that's going on here. It's not a big nefarious scheme. It's just money. It's just Treasury management more than anything else. But we're going to see how this goes. There's not a lot that they can do on this end of the spectrum. So we'll see, kind of how far this goes and what impact it has as it kind of pulls some of this term premium out. There's a very, very large short position on Treasuries in particular. And again, this is the hedge fund trade. Shorting Treasuries, doing the basis trade, that's been a big hedge fund transaction. These are short-term holders of bonds. They are price insensitive for the most part. This is a trade. And the Treasury knows that. And the Fed has even, as we discussed yesterday, the Fed even mentioned this in their June minutes, that there's a tremendous amount of players in the Treasury market right now that are short-term focused. And this is as opposed to pension funds and mutual funds, et cetera, that are long-term holders of Treasuries, foreign institutions, et cetera. These traders are very short-term, and this big short position that's sitting there is putting pressure on prices, lifting interest rates. And so by intervening into the market, they can potentially get rid of some of those short positions in the markets and help ease that term premium pressure that exists. So we'll see how this all works out. It's going to be very interesting. But again, we talked about a few days ago in the daily market commentary that there's a decent setup for bond trades right now, at least from a trading perspective. for a decent bounce in prices. And so we'll see what happens here. Yields are a little bit lower this morning. Bond prices are up on the back of this news. We'll see how it goes from here. But it'll be an interesting trade to watch. Outside of that, let's jump over to what you need to know before the bell this morning. So a couple things that we talked about yesterday. We talked about standard deviation, but if you didn't see that video, it's on our YouTube channel right now. But in that video, we talked about Bollinger Bands and using standard deviations to try to, get better entries and exits coming out of positions. I just want to talk a little bit about a couple of the markets this morning that is going on. This is the S&P 500, and again, we've been going through this very kind of slow motion correction within the markets, and we talked about previously a couple of weeks ago that we're entering into that seasonally weak period of the year. We're going to the pre-midterm election cycle, and that typically tends to be a little bit weaker for markets, and to expect a little bit of a correction. And we've started that correction. It's been very slow here. It's been very controlled. Volatility has not picked up to any stretch of the imagination. Sitting on the 20-day moving average right now. We kind of identified the 50-day moving average as potential downside, kind of that first initial downside in the markets. And again, we're just kind of slowly drifting down in that direction. Now, importantly, though, we're on a sell signal and momentum basis, so that certainly puts some pressure, on prices lower. But we're getting decently oversold. We're not completely oversold yet, so there's certainly some more downside risk here. But we are starting to work off some of that overbought condition that we had, after that initial kind of previous spike that we saw back in kind of early August. So again, just kind of working through that process. And we're seeing this kind of across indexes. This is the NASDAQ, very similar, below the 50-day moving average, below the 20, working down towards the 100-day moving average, again, on a momentum sell signal as well, suggesting some more potential downside pressure for right now. But again, getting decently oversold. That is, this kind of corrective process that we're in. And this is where it's a little bit frustrating. And as we've kind of talked about in Monday's article on kind of investor psychology, this is where investors start to make the most mistakes because, things just aren't working just right now. Positions you had aren't working. Positions you didn't have are working, and that gets frustrated. And we feel like we need to do something. But just be a little bit patient here because we're just going through this process of this kind of a corrective cycle within this market after that previous run. Very normal, exactly what you would expect to occur, getting down to levels of support. And again, at some point here, we'll see this turn, but make no mistake, this is what we talked about taking profits last week. We are triggering momentum sell signals. It does suggest lower prices. Again, we're just moving into September, which is typically seasonally the weakest month of the year. We're going to work through this process. The market's going to get oversold, and then you'll have your next opportunity for a rally. But this is that kind of point in time where we feel like we need to do something, but sometimes not doing anything is the better decision, and just kind of work through this process. Again, manage the risk in your portfolio. Just don't turn a blind eye to it, but don't overthink it too much. We're just in that phase of the cycle right now. One thing that I did want to touch on was Bitcoin, because lots of articles that had a huge rally following Bessent's announcement on doing the Treasury buyback. Very, very big jump. Finally got some signs of life. Talk about just the opposite of the story here. Momentum is at some of the highest levels that you typically see. Relative strength is a level that normally never exists in terms of overbought conditions. So with this move that you've had up to about 80,000 Bitcoin, you are extremely overbought. Again, going back to what we talked about yesterday with Bollinger Bands, standard deviations, you're extremely extended here. So if you've been in this trade, trying to work this trade, take some profits here. Again, doesn't mean that you should bail out of the Bitcoin entirely, but this is a very, very big move on a very short-term time frame, and that is potentially a risk. And again, don't let this chart deceive you. This is a fairly short-term chart. If we back this up, this is a 2-year chart of Bitcoin. We are still working off a very low level. So there's certainly, a potential here for Bitcoin to rally further. Absolutely, not saying that at all. But you're getting very, very overbought here on a short-term basis. And again, from a relative strength basis, just as something you don't see very often. So again, take profits here. Likely going to get a pullback to some degree for whatever reason occurs. And then you can kind of start building towards higher levels in the future and kind of start working the next kind of leg higher if that's what's coming. We'll see what's coming. But again, don't forget to take a little bit of risk off the table here. that's going to reverse itself, that kind of a spike. Anyway, that's what you need to know before the bell this morning. We'll come back, pick up with Jon Penn for Two Dads on Money. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
How can you pay for college without sacrificing your retirement? Our next dynamic learning series will show you how to create a flexible college funding strategy without jeopardizing your retirement or going into debt. It's the smart way to pay for college. Thursday, September 3rd, with Sarah Banger and Jonathan Penn. 529 plans aren't the whole story. Unlocking scholarships, education savings accounts, and making smart decisions before tuition bills arrive can help you avoid paying more than you need to. What's the smart way to pay for college? Register today for our dynamic learning series Thursday, September 3rd with Banger and Penn at realinvestmentadvice.com. Realinvestmentadvice.com.
You're listening to The Real Investment Show.
And good morning, welcome to the show. Oh, Bitcoin comments, please. Okay, well, there's your Bitcoin comments.
Good timing.
I know, I didn't even see the chat, so I appreciate that. So, what was the last thing you bought with Bitcoin? I have never bought anything with Bitcoin.
I haven't bought anything with Bitcoin.
It just kind of sits there.
Yeah.
Goes up and down in price.
Good question, Dale.
Great question. We'll see what happens. Anyway, good morning, John. How are you?
I'm good. How are you this morning?
Good. So, well, let's get to work. What we got to talk about this morning?
So several questions as of late around just interest rates, bond prices, specifically longer term yields.
Yep.
You know, I think folks are kind of getting concerned is there a certain rate on whether if it's the 10-year or the 20-year where it starts, causing some issues in the economy. Right? Will it cause things to break a little bit? So
yeah. Well, let's define break. Are we talking about BRAKE, like slow down, or BREAK?
That's a great question. So
yeah.
As in BREAK, break,
Okay.
like where things will severely get broken,
No.
right? Not just. So I like that break, BRAKE,
Yeah.
slow things down, right? So, but also when equities get volatile. Or equities start pulling back, folks get concerned.
Sure.
When equities go on sale, to your point, as you were talking about in just the opening bell segment, or before the bell, if rates are higher, that means bond prices are lower. So bonds are on sale.
Well,
right?
and a lot of things are on sale because
Yeah.
of interest rates, right? Because when interest rates go up, car prices come down.
Yeah.
Because they're not selling as many cars. And this is one thing that we always need to try to keep into focus. Again, there's lots of angst over home affordability. How many times do we see these, headlines about, it's just I can't afford to buy a home. And this is, and you're looking at it saying, I can't afford to buy it because you're looking at the mortgage payment. And you're saying, okay, the more it's psychologically, can you really not afford it? Or can you psychologically not afford it because the payment is higher than it was a year or two ago when rates were lower? But this is when you actually want to be, we talked a little bit about this yesterday. It's like, this is when you want to start buying a house because when interest rates are high, the prices have come down. And as I was noting yesterday, it's like there's more homes for sale in Houston right now than ever before in history. It's just a massive supply of inventory, and which means that the buyers have control. And with a 3% down payment for a mortgage, it's, on a $300,000 mortgage, you need $9,000. So it doesn't take a lot to make your down payment.
3%.
At 3%.
Yeah, I know. That's scary in itself.
Yeah,
though,
well,
if you think
that is
about
scary.
it.
Right, that is scary. But, there's, but then we get tied up into the mortgage interest rates. Like, oh my gosh, it's 6.5%. I can't afford it. But this is when you can buy value in the house, just like when a stock market goes down, right? That's when you want to buy stocks. But we never do that because stocks are going to keep crashing.
Because they could always go lower, right?
That's right.
At least that's the argument I hear is, look, things are at a better value, whether if it's equities, maybe it's a home. Well, equities, bond prices, so bonds are at a better value from a price standpoint, but then it's always, what if interest rates keep
going
screaming
up?
higher? Because I think the concern is seeing rates climb on the long end of the yield curve. I think, folks, that there's no cap in sight.
Right.
Right? And And I guess, are these rates that we're seeing today, are these high, or are they just higher than what we're accustomed to?
Well,
right?
that's a good point. But first of all, is there a cap to interest rates?
Yeah.
Absolutely. Because at some point, interest rates are going to break your economy. Whatever it is, and I'm talking about now, we're talking about an actual BREAK.
That's the EAK.
Right, yeah. Like
okay.
It's going to be a breakfast economy. But, yes, interest rates will get to the point to where everything shuts down, right? And you're going to have a recession. You're going to have, financial events, those type of things. Yes, that can certainly happen. But that's going to happen if there's a severe spike in rates. So in other words, you wake up one morning and rates are up 3, 4, 5%. It's not going to happen.
Yeah.
But that's what you're talking about. As long as rates gradually increase, it's a much less of a risk. It becomes more of a BRAKE on the economy because rates are gradually increasing. As rates gradually increase, the economy adapts for higher rates. Wages adjust, economic growth adjusts, supply demand adjusts, and we absorb those higher rates. It's kind of like inflation. Mm-hmm. As long as inflation is moderating and just slowly creeping up, the economy can adapt for it, right? We give people, we give people pay raises, et cetera, so they can adapt to that. When inflation spikes, like we had during the pandemic, coming out of the pandemic, we give everybody checks. There was no supply because we shut everything down and prices just shot through the roof. That's problematic, right? And the same thing with interest rates. As long as interest rates are just kind of slowly creeping up, whatever they're doing, and as long as that's occurring commensurate with economic growth, wages, those type of things, it's all absorbable. So it's not it slows economic activity, but it doesn't break it.
It's so great points there. So even if longer term rates that gradual increase, and eventually it'll put brakes, BRAKE, right? So I think a concern that I'm hearing a lot is look at these higher rates on the end of on the long end of the curve. Oh my gosh, it's so inflationary. Right. But I guess you can almost think of it as, well, if rates do continue to grind higher, if it does put brakes on the economy, it could be disinflate or less inflationary.
Yeah, no, higher interest rates are disinflationary.
Yeah,
not inflationary.
Yeah,
and so, but again, when people are saying rates are inflationary, no. Rates are just reflecting inflation in the short term, and right, we have an oil spike going on because of Iran, and so that feeds through oil prices. Oil prices feed through to inflation, so interest rates adjust to compensate for the current rate of inflation. Because if I'm loaning money for a fixed period of time, I need to make sure that I'm, making more money than what inflation's doing. So yes, rates adjust for inflation, but the higher the rates go, the more disinflationary impact they have because they slow economic activity.
Right.
But let's talk about something that you just brought up a minute ago, which is, are interest rates high?
Yeah.
That's the real story, right? So right now, if you talk about interest rates, everybody's like, oh, interest rates are so high right now. It's this is terrible. This is unsustainable, et cetera. Here's a chart.
Yeah.
Going back to 1982. Rates are normal. The 1977 to 2026 average is 6.16. We're at 5.28. This was as of last Friday, and this is there's an article published on the website talking about this exactly. The real rate is 2.76, which is about where we were from 2000 to 2007 before we started 15 years of zero interest rate policies, massive quantitative easing programs, everything we could to abnormally suppress interest rates. So interest rates have returned to normality after a period of abnormally low rates. And when you take a look at economic growth, we're growing at 2.5%. One thing that we overlook when we're talking about interest rates is, first of all, is the level of interest rates. Are interest rates high or low? Well, you've got to say, are they higher or lower relative to what? Right? And so when we talk about interest rates in particular, we're talking about interest rates as a function of economic growth.
Yeah.
So let's go back. What do interest rates reflect? Interest rates have to reflect something, and it's not monetary policy. It's not the deficits. It's not debt. What interest rates reflect is I'm loaning money into an economy. I'm loaning money to John, and we've talked about this before on the show. But John wants to borrow money from him. Well,
I don't care about what the national debt is when I loan money to John. I don't care what the deficit is when I loan money to John. What I care about is can he pay me back? So that's credit risk, right? So he's a good credit, so I'm not worried about him paying me back. So I'm not going to charge an extra premium on him for his ability to return my money back to me. But when I loan money to him for 5 years or for 10 years or for 30 years, then hang on, I've got to enter Brent's massive password here. He can't just have a normal password like normal people. 1111111.
Is there an exclamation point on the end of it?
2 of them.
Okay.
So, but when I'm loaning money to John, I want to compensate for what the expected inflation rate is. And if you look at the 10-year inflation rate expectations, they're about 2.5%-ish, give or take. I need to make sure that the money I'm loaning him, the rate of return I'm getting, is outpacing economic activity. In other words, that's opportunity cost. Could I take the $100,000 that I'm going to loan John for his Beanie Baby collection and invest that into something else that would give me an economically higher rate of return because the economy is growing strongly? So economic growth, inflation, credit risk, those are the kind of primary determinants of what sets that loan rate on your portfolio. Now, notice none of that has to do with the debts or the deficits, right? It has to do with opportunity cost, economic growth, those type of things. So when we start looking at how to measure that and looking at where are we in a normal interest rate cycle, well, right now, we've got decent economic growth. We've got economic growth that's growing at 2.5% right now. Inflation's running around 2.7-ish. So this is our economic composite index, and this is the whole point I'm trying to get to. This is the economic composite, which is in the black line. The red line is the leading economic indicator, 6-month rate of change. These two indicators have a near perfect track record with economic expansions and contractions. But because we had all that money going to the economy, we never had the economic contraction, even though all the economic data was declining back in 21 and 22 and 23. Everybody was predicting a recession. But economic growth never really contracted because all that money into the system. Since then, we've had this very big resurgence in economic activity. That index is up to 40.67 as of July. We don't have the August data in yet. But that increase in economic activity is why interest rates are coming up. And you should expect that because we don't have an unnatural suppression of interest rates. We don't have the Fed funds rate at 0. We have it at 3.67, right? It's the split between 3.5 and 3.75. And so that rate I've got to offset. I can't charge you a 2% mortgage rate when my overnight borrowing cost is 3.67 on average, the median point. So inflation is growing because you've got expanding economic demand, right? You've got interest rates that are not at 0. So interest rates have to normalize in that environment for borrowers that are borrowing money. And for the lenders who are lending it, they've got to make sure that their rate of return on those bonds is higher than what they would get just investing in other things or not loaning it at all. And so secondly, stay with me here, I got one more. And this is also a function of what's happening with the stock market. You'll notice that this economic composite indicator has an extremely high correlation with the annual rate of change in S&P 500 earnings. Why are earnings so strong? Because the economy is doing a lot better. Now, this has nothing to do with GDP, okay? This economic composite indicator is about 100 indicators of activity in the economy. This is not GDP. So personal consumption expenditures, is not part of this equation. This is things like the Fed Regional Manufacturing Index, the Chicago PMI, the Chicago Fed National Index, leading economic indicators, the OECD, ECD leading economic indicators, NFIB small business. It's the things that are actually happening within the economy. So the economy is growing very strongly. Now, that may not be represented in GDP, so to speak, right? Because of PCE, because of net exports, because of government spending, those type of things that are reflected in GDP. This is actual economic activity. This is why it has such a high correlation to S&P 500 earnings, because this is the activity that's creating the earnings for these companies within the economy. That activity is the demand, and that's what's lifting interest rates, if all that makes sense.
Does.
Right? Okay.
Yeah, and I also think there's somewhat of a concern, or maybe it's even a little bit of a misconception out there that, we see rates tick up on the long end. You look at 4.6-ish% on the 10-year. You're about a little bit north of 5 on the 20 and the 30-year. And I think we all think or assume that is the rate at which the government, that's the interest rate, that creates those debt payments on all of the outstanding debt that we have out there.
Right.
But I think, the average coupon on the debt is what about the average?
It's about 2.6.
2.6%.
Yeah.
Right? So it's going to be gradual. It's not like we're going to wake up one morning and all of a sudden the debt service payments are 5%.
Well, and that's the other side of this, is that, it's like, well, look at the interest payments on the debt. It's so high right now. And that's we spend more on interest than we do on defense spending. Yeah, that's true. But that's not abnormally high. Can you see this chart, Brent? Okay, just want to make sure we're still working over there. So, but this is a chart of the interest burden. It's basically just a tick lower than where we were back in 1991. And again, we're coming off an era of ultra low, zero interest payments, and back to just a rate of normality. So yes, our interest payments high, yeah, absolutely, but it's not unprecedented. This isn't the Shawshank Redemption moment of of the bond market, right?
Great movie, by the way.
It was.
Yeah.
But yeah, this is just, again, just want to keep some of the stuff in perspective, because look, this stuff makes great headlines, and there's everybody running around talking about all the different risks that are going on, and and there's certainly some concerns. Look, 40 trillion in debt is certainly a thing.
Yeah, it
right?
is. Yeah.
And I'm not dismissing that at all, because debt slows economic activity. It is going to impair economic activity as we go forward, right? It's not inflationary, it's disinflationary. So when you have aging demographics, you have high debt, that has a very negative impact on economic forecasts going forward, and it is certainly going to be an issue of creating an economic drag as we continue to have to navigate that debt cycle. So I'm not dismissing that this is a tremendous amount of debt. We just kind of get lost in this fact that this recent run up in interest rates to 4.7% on 10-year Treasuries, this massive increase, but it's just a return to normality after so many years. And we've just gotten so used to it. We got so used to 2% mortgage rates, 3% mortgage rates. It's like, oh, this is normal. That was never normal, right? I mean, it was never normal to loan somebody money for 30 years at 3.5%. That just wasn't realistic.
Yeah, well, I just find it interesting that not too long ago, there were many of us out there where we were looking for some sort of an account or an investment or some sort of vehicle that we could put money into where your money was liquid. You weren't going to have any risk associated with it, and you could earn interest of 3 to 4%. And several years ago, it just, with interest rates being so low, it just didn't exist.
Yeah,
it just did not exist. Well, now you can get it. And it just seems like as rates have been climbing here, but we're still freaking out about it. It's just interesting.
Well, the reason that everybody's freaking out about it is because it's all over social media, right?
So that all the headlines, and it's just sucking us all in.
Exactly.
Yeah.
And so we think this is this big national crisis moment because it's all you see. Everybody that writes a story in the Wall Street Journal or wherever it is like, I read like 8 stories over the weekend about 40 trillion in debt. It's a nice big round number, scares everybody. I get it. But nobody puts it into context. They all talk about this is the debt, this is where we are, and that ultimately means that there's going to be this massive economic crisis because of it. But nobody ever addresses Japan, which is 230% of debt to GDP. Nobody addresses the fact that the debt to GDP right now in the country, even at 40 trillion in debt, is lower than it was back in 2020. So everybody's dismissing the economic growth that's occurring underneath this, which allows you to support, that's the revenue growth you get as well, which allows you to support the debt. It's like, for instance, it's like saying, John, you've got a mortgage on your house?
Yes, I do.
You're broke.
Sorry, hon. You just heard it here. Sorry,
Well,
baby.
that's what I'm saying. It's like just because you have debt, you're
Right.
broke. We don't. But I didn't ask you what your income was.
Yeah.
Right. I didn't ask you what your ability to service the debt is. Right. I just asked you what your debt was, and I assume you're broke. It's kind of the same analogy with the government debt. Is that we're not looking at the revenues, we're not looking at the assets that the country
Offset it.
has that offset that debt. You've got to look at this as a balance sheet, and also remember that government debt is very different than household. One of the mistakes that people make is they go, well, a household can't run debt like this. The government's not a household. Their debt it winds up in your bank account. It's what's called sectoral balances. Every dollar that the government borrows ends up in the household bank accounts in some shape, form, or fashion, either through payrolls or benefits or whatever else we pay out. That all winds up in the household balance sheet. So debt actually creates economic growth, but there's a cost for that.
Yeah.
Long term.
So and I think the question behind the question that I've been getting a lot of lately, with that all this leads up to, is, okay, well, what does this mean, John? What does this mean for my portfolio? Should I be concerned about owning bonds as part of a portfolio strategy? My answer's been no. Right? I mean, if anything, this could potentially be an opportunity to add some additional exposure to bonds at better prices, right? But it just seems like there's just a lot of noise, and there's just a lot of this concern out there around owning bonds as part of a portfolio. And I just think it's a lot of narratives, and I think it's a lot of headlines just kind of knee-jerking us around a little bit.
It is. And
Right.
then, unlike Florian in chat said, how did the S&P act in 2008? Well, that was a very different story. That had nothing to do with Treasury debt. In fact, Treasury bonds were your savior during the 2008 financial crisis. That was subprime debt. That was $62 trillion of leverage subprime bets that we made loans to people that couldn't afford the homes they were buying.
Yeah.
We were forging signatures, we were forging incomes, we were doing all kinds of stuff to try to sell as many mortgages as possible. That was a financial transaction within the economy. It had nothing to do with the government. That was your lovely JP Morgans, Goldman Sachs, everybody else that was involved in that. They're the ones that are ultimately responsible for creating the financial crisis because of all the leverage bets. They stripped out, we've been through this story, but, when you can take a $2 or $3 trillion subprime mortgage capacity turned into $62 trillion of liability, that was where your problem came. And as soon as interest rates rose, it broke the back of that subprime mortgage. But that was private debt. That wasn't government debt. Very different story. And that really, and really honestly too, the financial crisis would not have been nearly as bad as it was had the federal government not shut down Lehman Brothers. So we would have worked through that crisis. Maybe the market would have been down 20, 30%, maybe 35% during that period. We wouldn't have had the economic devastation that we had. We wouldn't have had a lot of the revulsion in the markets that we had and revulsion in the economy that we had. But when we shut down, or when the Federal Reserve forced Lehman into bankruptcy, the problem that caused is that nobody trusted each other after that. Nobody would trade with anybody else. So counterparty risk went through the roof, because literally all of a sudden I had counterparty trades with Lehman, and they're put into bankruptcy. I can no longer trade with them. And then the question became, well, who's next? And immediately nobody would trade with anybody, and that completely froze the financial system.
Yeah.
And that's what caused the devastation. Outside of that, if you go back and look at a chart of the S&P 500 during 2008, we were just slowly kind of trending down to kind of a normal bear market. Lehman hits on the 18th of September, and it's a straight drop for 5 days.
I was back at Schwab in those days. I remember.
Yeah.
I mean, it seems like it was just yesterday, but also so long ago. But you're right. I think when that happened, when Lehman was forced, it seized everything. At that point, it became a trust issue, and it became a fear issue, and it just spiraled on itself.
Yeah, no, exactly.
Right.
And look, yes, the comment was loose government conditions caused the banking crisis. Yes, that is correct. But what I'm saying is it had nothing to do with government debt. Money transferred out of equity assets, out of mortgages, et cetera, into treasuries during the financial crisis, because that was your safe haven. But yes, look, lax lending regulations, that was absolutely the cause. We were loaning money to people that had no down payment. They had no job verification. They had no income verification. It was, and it didn't matter. I'll give you a good story. Back in late 2007, I was in California, went out there for a conference. And while we were out there in the conference, I got into a cab to go to the conference, and I was talking to the driver. I was always fascinated about California because, it's the house prices were just always, kind of out. In fact, he showed me so we're on the way to the conference. He showed me this house. It was a burned down shack on the beach. It was $1 million.
It's waterfront property.
And it was 900. It was like 900 square feet, literally burned down, and they were selling it for $1 million at that time. That was back in 2007, right? I don't know what it'd be worth today. But he was telling me that he's driving a cab, a regular yellow cab, and he lived in a $2.5 million house in California. Yeah. And we were talking about this. I'm like, this is just not sustainable. And so that was where we started, doing a lot of work back in 2007, early 2008. We started transferring most of our portfolios in June, July, early August into Treasuries out of equities because we saw what was coming with this unwinding of all this mortgage debt. But yeah, absolutely, you're right. A lot of this was loose government regulations that we have now resolved to some degree. Tighten some of that stuff up, but some of that stuff's starting to creep back in. We're starting to see lending regulations now starting to loosen back up again. But again, 3% down payments is not really restrictive to get people into homes that they can't afford, right? And again, it's not getting into the house that's the unaffordable part. It's the maintenance of the house that is unaffordable for a lot of people. I mean, people are so fascinated. I have to buy a house. Be careful what you wish for because, as I just found out yesterday, I've got a nice little bill coming to my house because the AC decided to drip down into the back wall of the house. So I've got to go have a bunch of sheetrock replaced. But that's just part of owning a home. That just happens, right? That's the things we don't talk about. But anyway, but to the point is you're right. So.
You got that on tape?
Which was?
You're right. That you're right?
Yeah.
So somebody in the chat was asking me to say, pardon me, is it zero? Is that what y'all want to hear? You want me to say the word zero. There it is. I don't know what it's for.
Zero?
But they wanted me to say zero.
Yeah, I saw that too. It was something about how Southerners actually pronounce the word zero.
Oh, is that it? Okay.
So.
Zero. That's how I say it.
Yeah.
There it is.
And see, here's JP in our comments, right? He typed out 40 trillion in numerics. Yes, it's a big number.
It is a big number.
It's a huge number. But you have to compare, that is irrelevant. You have to compare it to GDP. You can't you cannot take the numerator and not compare it to something else. And so you have to compare it to GDP. Debt to GDP is the number that you're looking for. And that, because we are getting economic growth. That debt, that 40 trillion feeds into the economy and it creates growth within the economy because that debt winds up in household balance sheets. So the 40 trillion number is, yes, it's a big number. You're basically, though, in a $32 trillion economy, give or take, right? So 120%. But again, if we get more economic growth because of AI, because of productivity, whatever it is, you can maintain the same level of debt and actually have a lower debt to GDP ratio because the economic growth is growing. So again, you've got to be careful taking numbers out of context just because, again, JP, it's a great headline. And everybody, this is what kind of fills the feeds and gets all of our fear narratives up. And it's like, oh my gosh, I better get out of the stock market because, this is happening and that's happening. It's $40 trillion to debt. It's all going to be a major crisis. Be careful with that.
Yeah. Yeah, I think we're getting so sucked into that 5% or look at what the higher rate is on the longer end of the curve, but we need to pay more attention to what's kind of going like underneath the surface.
Yeah.
Right. But I think we're just getting it's just very easy. It's very narrative driven, just like that $40 trillion number. Mm-hmm. I mean, that's not a small number, but I think it's just the shock and awe.
Well, it is. It's right? Shock and awe. But again, that's why you have to compare it to something.
Yeah.
Right.
Agree.
I mean, I've got you could have a Corvette ZR1. Man, I've got a really fast car until you put it against an F1, right? And then all of a sudden it's like, well, maybe it's not as fast as I thought it was, right? So, you have to compare it to something, right? You just can't just take a number out of thin air and say, okay, this is what it is. But, but again, also too, there's another side of the story that we're not touching on, which is that for the first time in 16 years, if you're retired or retiring or getting ready to retire, you now get paid to own treasuries, right? If I can get almost 5% income off a 10-year treasury with no risk, that does a whole lot of, if my goal is to create 6% of return, a portfolio that yields 6% a year, treasuries can do a whole lift of that. Now, if you're just worried about prices moving up and down, right? If your whole world is dictated by the value of your portfolio, and if every time you look at your portfolio, if you see red on your portfolio, you're like freaking out, then don't own treasuries. But if you need to create income on a risk-free basis, for the first time in 16 years, treasuries are giving you that opportunity.
Yeah, and so a lot of great points there. So I still get a lot of questions around, hey, I own this individual bond. I didn't think the bond's price was actually going to fluctuate when you own it, and it will. You're going to see it, the bond's price move in your account. If you're holding that individual bond, you're going to see that price move on your gain-loss page, depending upon what interest rates are doing at the time. But a question I get too is, how much, is there a certain amount that I should maybe allocate to treasuries? And that number is different for everybody. I mean, it's wonderful to have money set aside, like in a cash emergency reserve or a cash cushion, where you can pull from that to help supplement your living expenses or your retirement expenses. So that way, if markets do have a more volatile period, you're not being forced to sell or raise cash by selling equities at an inopportune time. So yeah, I think treasuries are very, very attractive today with today's rates. But I could still build the argument that even if somebody is retired or in your early stages of retirement, even if somebody's kind of well into their retirement years or that chapter of their life, I could still make a case, depending on what their return need is over time, maybe having some of their portfolio still in equities to help fight inflation. Because I still hear, hey, yes, interest rates on treasuries are still very attractive, but will that help me stay ahead of inflation over time?
Right.
Exactly. That's another concern that I hear too.
Yeah. And like there's another misnomer is like the dollar's losing value. And the dollar's only losing value if it's sitting in a jar. Right? Mm-hmm. The dollar loses value relative to inflation. So we're talking about purchasing power parity in the future. So if I have $1 today, will it buy $1 worth of goods tomorrow? And if I have $1 right now, it'll buy me $1 worth of goods today. It won't buy me $1 worth of goods tomorrow because of inflation. So the dollar loses value over time. It's been losing value since 1900 because of inflation. So that's one of those other narratives that are floating around. It's like, oh, the dollar debasement. No, that's just inflation. All that's saying is that you've got a lot of dollars sitting in a bank account that's like JP Morgan that pays you nothing on your cash balances. That is debasement. Right? This is why you go out and you take that money, you make sure it's in a money market fund or something that's paying you interest so that at least the value of your dollar is keeping up with the rate of inflation over time. And that's also another great thing when it comes to bonds. We talked about this yesterday. Mm-hmm. If I can pick up a bond paying 5% and inflation's at 2.5%, I'm getting 2.5% over inflation right now just to own debt. Now that doesn't adjust over time because that one bond is going to pay me 5% every year, going forward. So I've got to make sure and reinvest that capital, continue to grow my income so it stays above the rate of growth of inflation over time. But there's a lot of this concern about this devaluation of the dollar. It's great headlines. Again, it's another big narrative myth, but it's just inflation. That's all it is. It's just the rate of inflation, and inflation's about 2.5%. So your job is to make sure that your invested dollars right now are growing faster than the rate of inflation. And again, for the first time in 15 years, I can do that by owning bonds, stocks, gold, Bitcoin lately. But there's plenty of assets that are outgrowing the rate of inflation. So just sitting, if your money's sitting in a jar, yes, you are losing value. You're losing your purchasing power every single day. That money sits in something that is not generating a return. But that's why we invest. That's why you listen to the show, so that you manage your money better.
one last narrative here that I've been hearing a lot of too, or that's resurfacing, and that's, hey, our non-U.S. countries, our foreign countries, still buying U.S. Treasuries. Meaning, if there was ever a time where I had to sell my Treasury for whatever reason, is there a concern at all that there won't be a buyer on the other side of that?
No, there's always a buyer for debt. Always.
There it is, right?
Yeah.
But I hear that so much lately. Oh, foreign, they're not buying U.S. Treasuries, or folks are selling our debt. I mean, it's everywhere, and I see these narratives, and it's just simply not true. But I just wanted to pose that question to you for your thoughts as well.
Yeah. So again, Brent, can you bring up this chart for me real quick? Just to quell your concerns momentarily. This is just the foreign holders of U.S. debt, right? It's at record high levels. And why wouldn't it be? Again, if you compare U.S. yields to other countries, then and I've got the security of the U.S. Treasury, and I need dollar reserves for trade, why would I not buy U.S. Treasuries?
Yeah.
Right? And just remember this one thing. When everybody says that there's not a buyer for Treasury debt, there has to always be a buyer, right? We have primary dealers, which are required at auction to buy the debt. They have to buy it at the auction. But for every transaction, if I want to sell my debt to John, there has to be a buyer in order to execute that transaction. So for every buyer, there's always a seller in the markets. It just depends on what price, and what determines the yield is simply the price at which the transaction occurred. That's all it means. And so you hear a lot about these Treasury auctions. And it'll say, well, this is a failed Treasury auction because the yield came in at 2 basis points below the expected yield. So it's failed. All that means is that in that auction, when they transacted the deal, there was an expected yield. So let's say the expected yield was 4.50%, and just even 4.5%. The transaction goes off, and the negotiated price between the two raises the yield to 4.52%. Failed auction. It wasn't failure. A failed auction is when nobody shows up to buy. And that has never occurred. And it is not occurring now. It is simply the differential between at what price the auction occurs and what the yield is. And that's what sets interest rates. Interest rates are just a function of the buy and demand in the markets. And that's what that term premium is, which is the yield that buyers are requiring over the economic fundamentals that set interest rates. And that's it. That's all it is. It's nothing dramatic. It's nothing, dynamic that's sitting out there, and there's not this big crash that's coming. But it's just this is how the market operates. It's just the function of the Treasury market and the operations of the market itself. All right. Anyway, all right. I hope that helps a little bit. I think we spent way too long on that.
It was good.
Well, it's good for you.
It was good. Yeah.
So we appreciate it very much. All right. How is the fasting going? Mine is going well so far. Well, John, it's going very well. So
You're fasting?
Yes. Well, I always fast. So I misstated this, by the way. So there's a clip that Brent runs about talking about fasting. And I said that I fast from 6 a.m. to 11 a.m. And that's wrong. I meant 6 p.m. the previous night, from 6 p.m. at night to 11 a.m.
Yeah, there's a little difference there.
Yeah. So I try to fast for at least 12 to 15 hours every day before I eat. So why are you looking at me that way?
I think I'd pass out. I'll be on the floor.
You couldn't live with me.
I don't want to live with you.
Well, metaphorically, but still.
No. My wife's much prettier than you are.
Agreed. And she's not fasting.
No, she's fasting too.
Oh, yeah?
Yeah, cancer.
True.
Yes, because of her cancer, she fasts. So we fast together. We our last meal is between 5:30 and 6.
Yeah.
And then we don't eat until the next day.
And no coffee. Is that right?
No coffee except on weekends.
Wow.
So, man, let me tell you something.
Here it comes.
I look forward to Friday mornings. I go to bed Thursday night. I wake up like at 4:30 on Friday morning so I can get up, go to my living room, turn on the outside lights, and sit there and drink a cup of coffee in peace. That I live my whole week for that one moment.
And it better be a good cup.
It is a good cup of coffee. You know what? It could be crappy coffee, but for me, it's the best cup of coffee ever because I only get it on Fridays.
Yeah.
Anyway, 4 shots of espresso right now. Holy.
Scrape him off the ceiling.
No doubt. You know, his next comment in chat is just going to be a gibber of like.
No wonder why the chat's all fired up. Man.
String of Z's.
All right. Thank you for the well wishes from my wife. I do appreciate it very much. She's doing wonderfully, by the way.
She is.
She is. Her test results are coming back fantastic. We're just in our waiting period to get to remission. So, but do appreciate the well wishes very much. All right. That wraps up the show for today. We'll be back here tomorrow with live Q&A with Danny Ratliff. So we'll see you guys then. Be sure to like and subscribe to the channel. It certainly means a lot to us. We do appreciate it. And we'll see you back here tomorrow. Y'all have a great day.